Hi, my name is Lauren Templeton, and you are listening to Investing the Templeton Way. This podcast is for anyone interested in learning more about investing. In this podcast, I will be interviewing some of the greatest minds from the investment community and exploring topics ranging from international markets to behavioral finance. To learn more, please visit us at investingthetempletonway.com. The information presented in this podcast or available on the website is not intended as and shall not be construed as financial advice. This podcast is produced for entertainment value. Investing is inherently risky, and I encourage you to seek financial advice from a professional who is aware of the facts and circumstances of your individual situation. Thanks for listening. Hi, welcome to Investing the Templeton Way podcast. I'm your host, Lauren Templeton.
And I'm your co-host, Scott Phillips.
We're really excited about today's guest, Rob Arnott. Rob is the founder and chairman of the board of Research Affiliates. He is a member of the investment committee and the executive committee of the board. With Chris Brightman, he is co-portfolio manager of the PIMCO All Asset and All Asset All Authority funds. Rob has pioneered several unconventional portfolio strategies that are now widely applied, including tactical asset allocation, global tactical asset allocation, tax-advantaged equity management, and the fundamental index approach to investing. In 2002, Rob founded Research Affiliates as a research-intensive asset management firm intent on delivering innovative and impactful products and insights. He is co-author of The Fundamental Index, A Better Way to Invest, and notably earned his Bachelor of Science summa cum laude in Economics, Applied Mathematics, and Computer Science from the University of California, Santa Barbara. Welcome, Rob Arnott.
Well, thank you for the invitation. I'm looking forward to this conversation.
Yes, you have such an impressive bio. It looks like, based on the research that you have included on your website, Research Affiliates, that you've done a lot of research on inflation. So I just want to read 4 of the key points off your website and hopefully jump into a discussion on today's market and inflation expectations. So some of the key points from your website is that 1, the U.S. Federal Reserve Bank's expectations for the speed of reverting to 2% inflation levels remains dangerously optimistic. An inflation jump to 4% is often temporary, but when inflation crosses 8%, it proceeds to higher levels over 70% of the time. So I believe we're at an inflation rate of 6.5% right now, something like that.
But we crossed 8.
Yes, we did cross 8 in 2022. So do you still feel like we're underestimating inflation? And can you speak towards your views on inflation and perhaps the way that the BLS computes inflation and why there might be a lag there?
Sure. Our view is a lot more nuanced than simply inflation's headed back higher and is going to last longer. Our view, distilled down to its essence, is the consensus, whether it's at the Fed or on Wall Street or in the economics community, is the peak has passed and we're on our way back down. Might take a little while to get to 2%, but we're going to get there in due course, and inflation will be reasonably benign fairly soon. That's the widely held consensus. Our view is that consensus is entirely possible. It could easily be correct, but it's the benign end of the spectrum of possible outcomes, and it's very dangerous to make that your central expectation. So if you look at the best quintile of outcomes from 8% inflation, most of that best quintile is pretty benign. It's under control within 2 years, 3 years, 4 years. But there's an opposite end of the spectrum where it isn't under control for 12 or more years. And that also is about 20% of the outcomes. By the way, how do we gauge outcomes when the U.S. has been above 8% only twice in the last 50 years? We look across 14 developed economies around the world. We look back 53 years for all 14 economies, and you find 29 cases where inflation exceeded 8%. Two of them, 2 out of 29, came back down and were under 2% within 2 years. So anchoring on that as our expectation is very dangerous. Now, the consensus isn't quite that benign, but it's not far from it. The median outcome is that it takes 7 years to get back down under control. That's the median. Now, I'm optimistic relative to the data we looked at. I think that there's a good 50-50 chance that the benign outcome will happen. But I don't want to make it my central expectation. The risk of the left tail risk of inflation getting under control even faster than that is unlikely. The right tail risk of inflation surging again, perhaps late this coming year, and or remaining elevated for some years, that right tail is given zero credibility in the marketplace, and I'd say that's got a 50% chance too. So the point of our paper was not this is going to be out of control for a long time. The point of our paper was it's dangerously naive to anchor on a benign outcome as our central expectation.
I see. I know I've read in the past that you often talk about how inflation is calculated now versus periods in the past, like the 1970s. Mm-hmm. And you often comment on how inflation incorporated the price of housing in the past. But now the BLS is really focused on something called the owner's equivalent rent. Can you explain why that's significant and how this small nuance really impacts your thinking on the inflation readings?
Sure. It's actually interesting. There's probably not 1 out of 50 people in the institutional investing community who 18 months ago had any clue what owner's equivalent rent was, let alone why it was important. Today, that's not true. People are aware of it. I think that most are still behind the curve on how important it is. What happened in 1980? Inflation was out of control. We were coming out of Vietnam War, coming into a spending blowout under Carter, and it was a mess. Inflation crested at 14.7% in March of 1980. Volcker took it seriously and took Fed funds to 20% around the end of that year. So he took the Fed funds rate to 5% above the peak inflation. When people talk about Powell channeling his inner Volcker, to channel his inner Volcker, he'd have to take Fed funds rate to 14%. That's 5% above the recent peak. That's not going to happen. And even with Volcker, it took 2 years for inflation to get below 4%. And 6 years for it to get below 2%. So it took a while. Anyway, be that as it may, inflation did crest at almost 15%. And that was at a time when home prices were used to gauge home inflation. Now, the Bureau of Labor Statistics, the BLS, was so appalled by what they perceived as the tail wagging the dog. Home prices up over 20% in a year, pushing inflation to 14.7. Why on earth are we letting this one component be the tail that wags the dog? We got to fix this. And fixing it means bringing it down and making it slower and smoother and lagged. They came up with owner's equivalent rent. What is that? The rationale was, if you're a homeowner and your home goes up 20% in value, it doesn't feel like 20% inflation unless you're a new buyer or unless you're a seller. So to the homeowner, what matters is what would they pay for the house in rent? Well, you can't look that up in the newspaper I guess you can now on Zillow, but it's not very accurate. So when we look at owner's equivalent rent, how on earth do you measure it? You ask thousands of people every month, what do you think your home would rent for?
Yeah, it's a survey, right?
Yeah, I have no clue. If I was in the survey, I would maybe check Zillow, maybe make a wild guess. It would be in the very, very, very rough ballpark of correct, but hardly precise. And if it was not my first time in the survey, I would say, what did I say last year? Last year I said 4,000 a month. Okay, let's say 4,100 a month. People anchor on the past, they smooth it, they lag it. Home prices went up 10% in 2020, the start of the pandemic. Kind of shocking. Home prices going up, but looking back on it, if you've got work from home, you might as well want a nice home to work from. So it does make sense. Owner's equivalent rent in 2020 went up 2%. 2021, home prices went up 19%. Okay, that's a pretty big surge. Owner's equivalent rent, owners were starting to notice. It went up 4%. So in 2 years, OER was up 6%, while home prices were up 32%. What happens to that missing 26%? It shows up in OER over the course of the subsequent years, about half of it happening within 2 to 3 years. So that means OER should be expected to be unusually high last year, this year, and next year. And so you can predict OER based on the gap between OER and home prices. Home prices crashed in 2007 and 8 and 9. Owner's equivalent rent went up in 2007, 8, and 9, and finally had a small downtick, 2%, in 2010. Talk about behind the curve. Why does this matter? OER is 25% of inflation. Rent is also calculated in a fashion that creates an inherent smoothing and lag, and that's another 7%. So there's a third of CPI that's deliberately smoothed, lagged, and softened. If we use the 1980 methodology in 2022, inflation by September of 2022 would have been in the 12 to 13% range. If we use today's methods back in 1980, inflation would have crested at about 11%. Mm-hmm. So we just had a surge of inflation very, very similar to the cresting inflation in 1980, but it was understated, smoothed, and lagged, which means it'll take time for it to come down. Now, there's another nuance that many people miss. People pay close attention to the rolling 12-month inflation. Every month, you're dropping an old month and adding a new month. I have no idea what the January month is going to be. I do know what January last year was, and it was pretty high. In fact, it was pretty high January through June of last year, which basically means that for the coming 6 months, if inflation is reasonably benign, it will look like inflation year over year is crashing. If inflation is moderately high, it will look like year over year inflation is continuing to subside. You have to have very high rates of inflation, roughly 12 annualized, in the coming 6 months in order for inflation to stay where it is and edge up a little bit. The second half of the year is very different. We'll be replacing very benign months from 2022. And so I'm looking for inflation to give us the illusion that it's receded to somewhere in the 2.5% to 4% range by mid-year, and then reasonably high likelihood that it will create an illusion of surging again. And no, I don't expect us to crest above 8 this year, but I wouldn't be surprised if we finish the year at, let's say, 5 or 6%, which is certainly not the consensus today.
Rob, this is Scott. Your discussion on inflation is fascinating, and it brings up another topic of discussion that would bring in some of your work in valuation, I think. And you've had some very compelling pieces written on the evolution of valuation across the factors you track in your work. But one of the things that really struck me with your discussion just now was, when you look, you mentioned the consensus and the benign consensus. And when you look at the prognosticators of the Fed funds futures, they actually see rate cuts occurring in late 2023. And so there's some probability based on your work that, we could start to see an economic slowdown, but the Fed will be in no position or have an appetite to cut rates. And so I'm wondering, just kind of going back on your valuation work, you've cited that the momentum plays and some of the long duration plays that were extremely extended in the U.S. markets are still expensive today. So tell me a little bit about your thoughts on market positioning and what a surprise would look like if the Fed can't cut at some point in the near future.
Well, firstly, I think the Fed is determined to bring inflation under control. I think the Fed is speaking hawkishly because they believe that they will pursue a hawkish policy. But I think that if the economy begins to soften, and most particularly if unemployment starts to rise materially, that they will lose their nerve. I do think that Fed easing, perhaps around mid-year, is a very reasonable expectation, especially if, as I suggested, 12-month inflation dips to, let's call it in round terms, 3 or 4%. If that happens, then it makes complete sense for the Fed to say, okay, inflation's 3, we don't need a Fed funds rate of 5. And so for the Fed to back off is very plausible. But then what do they do when inflation starts to march upward in the second half of the year? That'll be very interesting to see how they play that. So a couple of things I find fascinating about inflation. One, people don't notice how important some components are until long after they've started to make a difference. OER and RPR, rental primary residence, being 2 cases in point. And secondly, hardly anyone pays attention to the months that are being dropped, which is crazy because you know what those numbers are going to be. They're already out there. So I look on inflation and the Fed's reaction. The Fed has been so far behind the curve on this. I was interviewed on our inflation work, and somebody said to me, well, Powell is forecasting that inflation will soften in the course of the coming year, but that he'll remain aggressive on controlling inflation until it's back down to about 2%. And my response to that was, how good have Powell's forecasts been on GDP, on Fed funds rates, on inflation over the last couple of years? Has he got anything right? If not, why do I even care what he's saying?
Well, Rob, the Fed right now is a little more Powell is more constrained than, let's say, Volcker. I mean, we're in a completely different situation in regards to debt to GDP, et cetera. How do you think about the Fed's constraint there and how that might affect future Fed policy?
Just to be clear, I'm not a hawk. I'm not one of these people who thinks they should channel their inner Volcker and repeat what Volcker did. The Fed claims to be data dependent, but the data they're paying attention to varies from month to month and always seems to be whatever took them by surprise last. One data point that they never talk about is the long bond yield as an indicator of where Fed fund rate policy ought to be. What do I mean by that? Cam Harvey, an advisor to our firm, was the originator of the recognition that yield curve inversion predicts recessions. It was the thesis of his PhD dissertation back in 1988. And finally, he's starting to get some credit for having been the first to notice this. But I would argue that an inverted yield curve doesn't predict a recession. It causes one, a much stronger statement. What do I mean by that? If the long rate is 3.5 and the short rate is 4.5, the long rate is set by the market, not by the Fed. The long rate is set by supply and demand, and the long rate tells us that the market's comfort zone for long-term debt that is immune to default is 3.5%. Now, you can think of interest rates as a speed bump for the economy. If it's too low, you get a lot of reckless driving, misallocation of resources, malinvestment, squandering of resources on empire building and dumb ideas. And if the speed bump is too high, the economy stops cold. The other way to think about interest rates is as a reward for deferred consumption. If you are lending at 3.5% for long-term bonds, you're basically saying, I'm willing to defer consumption for 10, 20, 30 years in exchange for a 3.5% payout. That's the reward I demand. Now, why on earth should the reward for short-term deferred consumption be higher than for long-term? So I think central bankers all over the world should focus on the long bond and should view their policy range as being somewhere between 2% below the long bond yield and 0.5% below the long bond yield, but below it, not by a huge margin. When we had long bond yields of 4 and Fed funds at 0, that makes no sense at all. Mm-hmm. That's zero speed bump, zero reward for deferring consumption, zero reward for investing in innovation, and ample reward for borrowing to fund whatever stupid idea you want to fund. Whether you're an individual looking to overconsume or a company looking to buy back stock instead of investing in a new long-term initiative, or a government looking to spend money to win votes. So on all of these levels, the zero interest rate mantra of the last decade was massively destructive to a healthy capitalist economy.
Rob, I couldn't agree more. It's amazing when you think about it, what type of behaviors that interest rate policy induced. And I think we'll just look back on it over time and hopefully think, whoa, look at all of this misallocation of capital. Look at the bad behavior that this created. I mean, I'm hoping that that's where we'll go, but it really is just amazing. In the equity markets in 2021, I believe Scott and I calculated that there were over 700 companies trading on U.S. exchanges that were trading at a price-to-sales ratio at over 20 times sales.
Good Lord.
I mean, it is really frightening when you see these numbers. It is much bigger than the dot-com bubble, which is where I began my career. Mm-hmm. So it is shocking to think about interest rate policy and the behavior that it induces. I know you often will comment on Australia. Do you want to maybe explain what their policy was and Absolutely. Why you think that was a reasonable policy?
Well, Australia was for a long time called the lucky country because for 30 years they did not have a recession. They had no recession in the aftermath of the tech bubble bursting. They had no recession during the global financial crisis, no recession, and only finally had a recession in the COVID lockdowns, which, of course, Australia embraced to an extreme. Now, how did they avoid recession for 30 years? Their central bank interest rate was 1% to 2% below the long bond yield for 30 years.
Mm-hmm.
So Rudy Dornbush was a famous MIT economist in the 80s and 90s. And in 1998, he famously quipped that no economic expansion dies of old age. They're all murdered by the Fed.
Mm-hmm.
And I think that holds true to this day. The expansion of the housing bubble was nipped in the bud by Fed funds rates going above long bond yields in early 2008. And so that was the Fed saying, we got a bubble going, we need to rein it in. Okay, let's kill the economy. Meanwhile, Congress had played a very significant role in all of this by creating incentives for people who had no business buying a house to buy a house. I mean, think about it. If you are not making a lot of money and need to be mobile so you can move to take a better opportunity if you find one, why on earth do you want a house that you can't afford? But homes were made accessible to people who couldn't afford them, which did them a lot of damage. It hurt the people it was supposed to help. And this is all a bipartisan issue. So the Fed killed the housing bubble. It ultimately killed the FANG bubble. Yield curves, people forget this, went inverted in late 2019. We were already on record saying we are probably rolling into a recession that people aren't noticing could be coming. We didn't have prescience that COVID was going to be a freight train running over the whole world, but we did see objective risk of recession even in the absence of COVID. And ultimately, the FANG bubble crashed of its own weight. Things just got way too frothy. The S&P 500 was much more concentrated in its top 5 holdings at the peak of the FANG bubble than it was at the peak of the tech bubble in 2000. A lot of people don't know that, but at the peak of the FANG bubble, the 5 largest stocks in the S&P 500 were 23% of the S&P. At the peak of the tech bubble, it was about 5% lower than that.
And of course, that's because the S&P 500 is market cap weighted.
Correct.
I know that you have your fundamental index. Do you want to explain that to my listeners and how that differs from a market cap weighted index or even equal cap weighted?
I'd love to. Okay, let's dive in. The concept of fundamental index was inspired by the tech bubble. I had a dear friend who was founder of the Common Fund and on the board of New York and Virginia state pensions and so forth. He was very well connected, and he was horrified. He saw 4% of client portfolios being put into Cisco, a relatively small company at the peak of the tech bubble, and he saw those holdings marked down 80% within 2 years. He said, there's got to be a better way to create an index. And he and I and a fellow named Marty Leibowitz, who at the time was vice chairman of TIAA Craft, got together and did a little brainstorming. And I said, well, why do we weight companies proportional to price? Why don't we weight companies proportional to how big their business is? And it's an idea I'd been toying with for several years, but never pushed it to front burner. So we tested it. We thought, well, the net worth of a company, its book value, perfectly reasonable basis for choosing the 500 largest companies, perfectly reasonable basis for weighting an index, or do it on company sales. The Fortune 500 was launched in 1954. Imagine if they'd said, hey, we're doing all this work to find the 500 largest sales companies in the U.S. Why don't we create an index of those 500 companies weighted by the sales? Interesting thought experiment, because if they'd done that, fundamental index would have preceded cap-weighted indexing, and cap-weighted indexing would never have caught on. it would never have been embraced. The rationale for embracing it, if a sales-weighted index already existed, would be theory tells us that the market cap-weighted index can't be beat on a risk-adjusted basis if all prices are correct, if there's no trading costs and no taxes, and if all investors believe that all assets have the same expected returns. Pardon me, that's a big pill to swallow. And then you'd look back historically and say, gosh, in the 20 years before the first index funds in 1974, after the launch of a Fortune 500 index, the Fortune 500 index would have won in 16 out of 20 years, but this other one is theoretically better, so let's use it. No, nobody would have used it. Fundamental index, my biggest shock on fundamental index is that people hadn't done it. They'd done variants of it. They'd done selecting stocks by fundamental economic footprint and then cap weighting them. They'd done weighting by fundamental measures, but picking stocks by market cap. So fundamental index was basically new when we rolled it out in 2004. What is it? You find the 500 or the 1,000 largest businesses in the U.S. chosen on the basis of what are the company's sales as a percentage of all publicly traded businesses? What are its profits? What are its dividends? What's its book value? Each of them measured as a share of all publicly traded companies. And because these are four very, very different financial measures, you just average the four weights and say, okay, that's about the right size. So we're going to hold that stock if it's one of the 500 largest, and we're going to weight it according to its economic footprint. What could be simpler? And it has a stark value tilt. Growth stocks trading at premium multiples are reweighted down. Value stocks trading at deep discounts are reweighted up. So it is value tilted relative to the market, but it's an exact mirror image of the market's growth tilt preference for growth stocks relative to the macroeconomy.
I see. That's very interesting. You know, picking up on that growth value discussion, it's been a long decade for value investors like myself. And it's been nice to have a bit of reprieve. You know, so often we reflect on growth versus value. I mean, I think that whole conversation gets a little stale. Even John Templeton, who is a well-known value investor, he loved growth. He just didn't want to pay for it.
Yeah.
So who doesn't like growth? But when we think about growth versus value in a rising rate environment, I mean, of course, everybody immediately thinks about the Gordon growth model and the impact of interest rates on growth versus value and the higher impact of higher rates on growth stocks, that growth stocks should be more penalized than value stocks. I think most of my listeners will understand that argument, but you actually think that inflation is the bigger piece there, that inflation is going to impact growth stocks more than value stocks, and that value stocks have a much lower duration, so to say. So do you want to speak to that a bit?
Sure. Well, Cliff Asness came out with a piece a couple of years ago showing that the linkage between interest rates and growth versus value is pretty weak. And that surprised a lot of people because the narrative just makes sense. Higher interest rates mean a bigger discount rate. Growth stocks have more of their future rewards for shareholders out in the distant future. So a higher discount rate means lower value, all of which makes sense. But what people overlook is that the Gordon model has a discount rate and a growth rate, and the two are connected. So when you have higher interest rates, it's often because you have higher expected growth. And so they almost cancel. Now, what doesn't cancel is inflation. Inflation, there's no such thing as elevated but stable inflation. It has never happened anywhere, probably never will happen. Elevated, stable inflation would be innocuous because everyone would be expecting it and would be investing in accordance with it and so forth. when you get elevated inflation, you get massive increase in risk and uncertainty. What better approach to invest in a period of elevated uncertainty than to buy companies that have just a ton of sales, profits, net worth, nice rich dividend yield to protect you against that uncertainty? And why would you want to take your chances on something, a frothy high flyer trading at 10 times sales, where you don't know with confidence what the sales are going to be in this period of elevated uncertainty?
That is very interesting. My other question for you today is just in regards to the culture at Research Affiliates. And I find this so interesting because my uncle, John Templeton, he was a huge advocate of the scientific method.
Yes.
I mean, he talked about it a lot and really admired the scientific method. I've read some of your thoughts on data mining and the culture that you have created at Research Affiliates around the scientific method instead of data mining.
I'm going to take it back even further than my career. I'll go back to the beginning of my career. In high school and college, there were two things that utterly fascinated me. One was astrophysics. The other was finance, investing specifically. I realized in college that I was darn good at math, but that to be a world-class astrophysicist, I would have to be a mathematics genius, and I wasn't anywhere near that. I also realized that scientific method wasn't used in finance, and that applying scientific method and quantitative tools in a marketplace that didn't really use them would be a much more exciting career. And it turned out to be a good call. Bringing it up to the not too distant future, the government policies embraced during COVID involved this mantra, follow the science. What is the essence of scientific method? It is open-mindedness towards alternative perspectives, a willingness to study alternative perspectives, a willingness to advance a thesis and then try to prove yourself wrong. Not find confirming evidence, but find out if there's any evidence that you're wrong. This is the essence of scientific method. And the follow the science mantra was total rubbish. It was anti-science. The quant community in finance today embraces elements of scientific method, but not the willingness to question and challenge your own thesis. And so I think even now, a willingness to pursue a purer form of scientific method is a good path to continued success in finance, even though the quant community is now, in some ways, a dominant community in finance.
Hey, Rob, we also share the same perspective on a quantitative discipline. And I've seen your views recently, which, of course, it's somewhat selfish, but we like them as well because they reflect our own views back to us. But you see some interesting opportunities in the markets even today with all the turmoil. Why don't you maybe walk us through the things you see in international markets, emerging markets, small cap U.S. value, and what that could mean potentially, what the implications are to investor portfolios who are willing to go out of consensus and follow the numbers?
Sure. One of the things I found fascinating during the frothy bull market of the 2010s was the constant reference to low interest rates stimulating equity returns. And yes, there's a link. There's a connection between the two, but it's remarkably mild. The so-called Fed model that compares 10-year bonds with yields with the earnings yield on the stock market fits like a glove from 1965 to 2005. You widen it out and look at it over the last 150 years. That's the only period of time when it fit like a glove. It's a terribly weak link. And so one of the things that I like to do is look for contrary evidence. That linkage with interest rates, if it's a powerful link, why in the mid-50s was the market trading at a Shiller PE ratio of 10 at a time when 10-year treasuries were yielding 2? Why on earth would European and Japanese stocks be priced at half the U.S. Shiller PE ratios when their interest rates are lower than ours and in fact were negative? So the narrative collapses as soon as you look outside of the limited horizon of U.S. in the 2010s. And so I look around and I think, okay, I don't see any compelling reason that Europe and Japan should be at half the U.S. multiple. Do I believe the U.S. is in better shape to enjoy robust economic growth over the next 20 years than Europe or Japan? Yes. Enough to justify a 2-to-1 valuation difference and a 2-to-1 dividend yield difference? No. And so I look around the world and I think there's some markets out there that are cheap. Everyone knows why they're cheap, but the rationale for them being cheap falls apart when you look at history and when you look at how long the U.S. economy would have to outpace their economies to justify the valuation differences we see now. So I look around today. I've been called a perma-bear because I'm patiently bearish on assets that are fully priced or overpriced, but I'm bullish when I see markets that are cheap. And international stocks are cheap today. Emerging market stocks are cheap today. Emerging markets value is dirt cheap today. Trades at a Shiller PE ratio, the value half of the emerging markets trades at a Shiller PE ratio of 10 times earnings. So that's 10 times the sustainable long-term earnings for these businesses. Wonderful valuation. RAFI, fundamental index in emerging markets, is priced at 8 times the sustainable long-term earnings. So as I look at these comparisons, I think, well, gosh, for the patient investor, there's some wonderful opportunities out there. MLPs, also very interesting. And the list goes on. So we did a short paper that hasn't been published yet that looks at relative valuations a year ago versus relative valuations today. And a year ago, over half of the 16 asset classes that we track were priced to give you subsequent 10-year returns that were below the expected inflation rate, negative real returns. Now, all but one market, T-bills being the only exception, are priced to give you positive real returns. So you've gone from 10 out of 16 asset classes priced to give you a negative real return to 15 out of 16 priced to give you a positive real return, and several priced to give you well over 5% real. So I look at today's markets, and people say, if you're expecting recession, should I get out? And my reaction is, the market's already pricing in a modest recession. Mm-hmm. So unless you believe that the recession will be severe, this is not a time to sell. This is a time to look for entry points into markets that are cheap, not necessarily U.S. stocks.
Yeah, we would agree. I've heard you use the phrase in the past, maybe it's peak fear. Of course, John Templeton always said maximum pessimism. So, people always say,
how do you different ways of saying the same thing.
Yeah, how do you know when we were there at peak fear and maximum pessimism? Of course, there's only in hindsight do you know, but there are typically some clues. 2022 was a terrible year. We do have an inverted yield curve right now, whether you're looking at the 3-month and 10-year or the 2-year and 10-year. Are we at peak fear right now?
I would say no. I would say we are at elevated fear. I think in the fourth quarter, we were at peak fear in Japan and Europe. Mm-hmm. And perhaps also in emerging markets. You had the war in Ukraine, limiting energy and food exports from two key economies that export vast quantities of both. You had COVID showing no signs of going away. You had the Fed finally getting religion and realizing, oh, this inflation's not dissipating fast. maybe we should do something. And just as an aside, taking Fed funds to 3.5, I thought, why not just do it in one step? And then just wait and see how it plays out. But you had a lot of dynamics that were all creating headwinds, and particularly for Europe, which had a war on their doorstep, that has a sociopath running a major nuclear power near them, that had questions of energy supplies to allow their industries to function, to allow their homes to be heated in the winter. One of the things that Putin did on day one of the invasion that got no attention at all was he cut off exports of fertilizer.
Mm-hmm.
If you don't have fertilizer, your crops are going to come in smaller than expected. And so that was a deliberate shot at Europe. And it got very little attention. It didn't work as well as he hoped, but it was a very direct shot. So last October, November, I think we were at peak fear in Europe and Japan, the fear of the war spreading, the fear of good German citizens freezing to death in the winter. These are all legitimate fears.
Sure.
But the simple fact is when you're at peak fear, the reality is almost always milder than the fear. And it doesn't take good news to create a bull market. It creates a dissipation of bad news.
Yes. Well, and we haven't seen a piece come out like the 1979 piece, The Death of Equities, yet. So I think people haven't fully given up on equities. I have two last questions for you. One is really weird, and we might completely cut from this episode because I don't want to lead you anywhere that you don't want to go. But it is, I've heard you describe yourself as a libertarian. Some of your comments surrounding negative real rates and the moral hazard they create. It reminds me that John Templeton, and a lot of people don't know this, but he actually tried to create his own nation, and he got pretty far. It was called the Republic of Minerva, and they actually had their own currency printed, and you can buy the coins. I occasionally do on eBay. They'll come up for auction, and I'll go buy some Republic of Minerva coins. Scott, you can tell a little bit about, do you remember the background of it, who he started it with, or? Yeah.
He had two other partners on the venture. They're both two wealthy businessmen at the time. And so they purchased this island in the South Pacific, and they got to work dredging out the bay and creating a port. And it was going to be this kind of free enterprise, free society oasis, I guess. And so apparently the United States government was upset by this and sent the nearby country of Tonga to claim it as their own. So they came and took over the Republic of Minerva very quickly. And I think the lesson was, if you're going to start a country,
keep it quiet.
Start with an army first.
And don't tell anybody you're doing it. But the reason I bring this up is, Scott and I were lucky or wise enough to be short crypto through 2022.
Why we weren't short from 2013 to 2020?
Yeah.
That's right.
Well, I think we put on the position in January of 2022, and it was a very lucrative position.
Cool.
But what are your thoughts on cryptocurrency and digital assets? And I'm asking this question not because of, what we've seen from FTX and Sam Bankman-Fried or anything like that, but I'm just curious your thoughts on central banks, their role, freedom, free society, and the role of crypto and digital currencies.
As a libertarian, I want to like crypto. Simple fact is, it's not a currency. A currency has three purposes: a measure of the worth of anything and everything. The microphone I'm speaking into has a particular price tag attached to it. That's a measure of its worth. When I buy groceries, I'm spending money that I earned. The money I earn is a measure of my hourly worth. it also serves as a store of value intertemporally. That means that if you set aside a currency today, it will buy about the same amount of stuff 1 year, 2 years, 3 years from now. Ideally, it should buy the same amount of stuff 20 years from now. That was the store of value that I just talked about. Yeah, a medium of exchange where I can do work and buy groceries when I don't run a farm and I don't create the food that I'm going to be eating. So it has those three purposes. It fails all three. It has no stability or predictability as a store of value. It is an utterly unstable measure of the value of goods and services. It's almost useless as a medium of exchange. Famously, the first transaction involving Bitcoin was the purchase of 2 pizzas. Somebody created the pizza index that I think peaked at $175 million. That those 2 pizzas cost $175 million in the subsequent peak value of Bitcoin. It fails all three measures. So while I would say I'm rooting for crypto to give central bankers a proverbial run for their money, so to speak, they fail all three core purposes of currency. I found the idea of Bitcoin fascinating. And so in 2013, I was thinking about buying some. I thought maybe I'll just put $100,000 in and see how it goes. Well, instead I decided I don't buy things I don't understand. So I'll buy 1 Bitcoin.
Right.
And I still have exactly 1 Bitcoin, and I still watch its value as it goes around, and cost me $225. So I guess I'm still in the black. Anyway, I love the concept. I don't understand how one could ever possibly value it or use it in lieu of the fiat currencies that dominate the world today.
Yeah, we share a similar view. Well, my last question for you is going to be an easy one. I have read that you collect vintage motorcycles and vintage wines.
Mm-hmm.
But can you tell me a little bit about your motorcycle collection, about any prized motorcycles in that collection? My dad drove a Triumph, wore off Harley, and then when I was in high school, bought a Harley Davidson, and then took me on a drive up a mountain on it, and I think scared himself that he had just taken his daughter. Maybe he leaned a little too far into one of those curves. Yeah. And he came back and sold his motorcycle. But I grew up in a family where my dad loves motorcycles. So what is your favorite in your collection?
Oh, I have several favorites. My collection is small, but very, very, very good. I like to collect fastest of their era bikes. I have a 1921-22 Brough SS80, which has the name Old Bill. What is Old Bill? It's the winningest motorcycle in the history of racing. It won 52 races in a row.
No kidding. Wow. And is it in working condition?
It is in working condition. I have not yet ridden it. I would like to ride it once just to say that I have.
Yes, you need to.
But I don't want to risk a rolling piece of history. There was an industrialist in Italy named Morbidelli who was in his youth motorcycle racer, and he decided in the 90s to build the world's best motorcycle. So he took the Cosworth V8 race engine from car racing, took it to his friend Enzo Ferrari, and said, do you think this would work if we shrunk it to motorcycle size? Ferrari built 4 custom engines that were just miniature Cosworth V8s.
Really?
850 cc, and they were put into 4 motorcycles. And Morbidelli realized, this is the world's best motorcycle, but it's going to cost more than a Porsche Turbo. Yeah. And I don't think there's a market for a motorcycle that costs more than a Porsche Turbo. So it never went into production, but that's another prize one. Anyway, I love motorcycles. I ride them much less than I used to. I don't trust my instincts as much as I used to. But I have another one coming. There's Aston Martin's coming out with its very first motorcycle called the AMB 001. Model 1. Brough makes high-performance motorcycles, so it's Aston Martin and Brough in partnership. And it's 180 kilograms and 185 horsepower, so it has more horsepower than weight.
That is unreal. Yeah. Wow. That's very exciting. It must take some work for you to keep these in running condition, just to maintenance their engines and stuff like that.
I have a friend who works full-time for Jay Leno, who comes to take a look at my collection and see what needs doing once a month. And that works just fine for me.
That's amazing. I'm from a family of car racers. I said my dad likes motorcycles, but he also raced Formula Ford cars and Formula V when he was a kid. My grandfather, Sir John's brother, created something known as zero roll suspension, and he built all of his race cars by hand, and they're still bought and sold on the vintage circuit. They're all named after the J.R. Tolkien series, so they all have names like Shadowfax or Ringwraith. But I grew up going to all those races, so I have an affinity for all of that. And it sounds like your collection is amazing. I really appreciate all the time and insight you've given us today. It's been a really enjoyable interview, and we just really appreciate you, Rob.
I enjoyed it immensely. Thank you for your time.
Yes, thank you.
Thanks, Rob.
All right. Bye-bye.
Bye.
Thank you for listening to Investing the Templeton Way. Please be sure to subscribe on your favorite podcast player. To view the show notes and resources mentioned in today's show, head to investingthetempletonway.com.